So it's a pleasure to be here today. The topic of my talk today, and I just want to keep this very, very interactive, is 2025, the year of global information reporting. I was just asking a question on purpose because basically what we are seeing right now is a global change in the way governments think about digital assets and crypto. They see that there is a lot of revenue that is received and they want to participate in those money flows. So basically 2 years ago, the OECD came together and, similar to the Financial Action Task Force, agreed on global standards that are similar to the common reporting standards, the CRS that we know from the traditional financial sector, and introduced the so-called crypto asset reporting framework. What is the crypto asset reporting framework? Has any one of you heard of the crypto asset reporting framework? 1, 2, 3, 4. Okay. 5. The crypto asset reporting framework basically builds on 3 pillars. We have first, the scope is it includes entities that provide intermediary services with digital assets. So basically, think of almost everything regarding effectuating a transaction. And this can be something like, for example, the OECD said back in August during the negotiations, the question came up, are DEXs in? Do DEXs need to report under the crypto asset reporting framework? And the OECD said, yeah, by default they are in, because why should they be out, right? So there is a lot of discussions there. So the crypto asset reporting framework, what is it? It's similar to the Financial Action Task Force regulations when we talk about the travel rule. It's based on recommendations. So the crypto asset reporting framework consists of 3 pillars. First of all, service providers that provide services need to collect tax identification numbers from their clients, or anything related in a single jurisdiction that would allow the tax administrations know where an individual is placed and where they need to pay taxes. Number 2, and this is where it gets interesting, is all those intermediaries need to report customer activities to the local tax administrations. Meaning that by the start of 2026, every single service provider within a CARF jurisdictions, and when we talk about CARF member state jurisdictions, we talk about 63 jurisdictions, including BVI, Caymans, Dubai, Seychelles, US, European Union, so Hong Kong, Singapore, Australia, pretty much everyone's in. So basically, the service providers in those jurisdictions will need to report information about customer activities to the local tax administrations. They need to do so in different ways. In Brazil, for example, it was proposed that there would be like a monthly transaction-based reporting requirement for service providers for every single transaction of every one of their users to the tax administrations, which of course is very, very difficult, not just for the service providers to comply with, but also the question comes up, like what happens to that data, right? So can the government actually evaluate it and work with it? So what the CARF said is, okay, we're not going to introduce transaction-based reporting, like, for example, the United States did recently with 1099 DAs, but we're going to introduce aggregated amounts reporting. So now service providers on a global basis will be required to report the aggregate holdings and transfer amounts of their individual users to the tax administrations globally. So I give you a very simple example. We have an exchange that is based in Switzerland, servicing 1 million users. Out of these 1 million users, they provide you with tax identification numbers that would allow them to actually sort through. We have people from 25 different jurisdictions. So what happens is those people trade on these exchanges, they have in and outgoing transactions, they have transactions on the exchanges, and then by the end of the year, the exchange in Switzerland would actually report to the Swiss authorities. The Swiss authorities would then sort through this data, divide between domestic and foreign taxpayers, and would send the foreign taxpayer information to the so-called Common Transmission System, the CTS of the OECD. And it then gets transported to the tax administration that is responsible for evaluating individuals. So, where does this lead us to? The purpose behind this crypto asset reporting framework was really to introduce a risk assessment tool. So basically for individual jurisdictions to know which individuals actually hold crypto. Because in the space of crypto, what we have seen is that in a lot of jurisdictions, we have a tax transparency anywhere between 0 and 10% max. And that's because like the burden of reporting on taxes has been solely on individuals. Whereas, for example, in the United States, you have 1099 reporting, where service providers report to the IRS, and they also send something to individuals that are trading. And so the IRS would always know, okay, who's trading on a certain exchange if there's certain amounts or thresholds exceeded. So what the crypto asset reporting framework now will end up to is that tax administrations globally will be provided with information about their local people and who holds crypto. So very simple example, Vienna. In Vienna, we have 3 of the largest exchanges globally. So we have Bitpanda, we have Qcoin, and we have Bybit that are incorporated in Vienna. All of these exchanges will service more than 10 million people for sure in Europe. So they will need to report to the Austrian government, and Austria has 8 million population. So the Austrian government will receive more information about crypto traders than they have in totals about the amounts of people that they have in the country. So the question is, what does the tax administration do with this information? Something we have seen also already in the traditional financial reporting world with the common reporting standards, where tax administrations were flooded with information, but after all, they couldn't handle the data and couldn't really evaluate it. We see it already with information reporting requirements that kicked in Spain and in Italy, where the tax administrations are sitting on tens of thousands of Excel sheets and CSVs that they cannot evaluate. So they have no clue what they are doing. This is a situation that we as Taxbit saw and that we are working on at the moment also with US government and other larger administrations globally, is really help them with these bulk data assessments and like how you can actually make sense of the data that was reported. So basically help the government to distribute information to individual taxpayers and also automate the process of information reporting and data ingestion. Okay, so there was a lot of stuff about the technical framework. So the question is, what happens then, right? So something I've been discussing quite a lot is like, if you think about how criminal investigations are currently today triggered. We have someone from Chainalysis here that will be able to tell you that a lot of the on-chain investigations are actually triggered through an event that occurred on-chain. For example, payments in darknet, right? You would do further investigations. You have an AML, like someone sends crypto assets to an exchange and then Chainalysis flags it and there's like a tagged address. So there would be further investigations required. The way criminal investigations will be soon triggered, and this is something where we really just look 1, 2, 3 years in the future, is that the government will receive a lot of off-chain data. They will identify a lot of cases of non-compliance combined with PII. So because they had to do KYC, they will receive that individuals hold a lot of crypto and trade a lot of crypto. They will identify a case of clear non-compliance where people did not pay taxes on crypto because, like I said, tax transparency ranges from 1 to 10%. So we will have like at least 70% of users from Zexis that then will be identified as cases of non-compliance. So we break this down to being a law enforcement agent or a CI investigation authority. By the rule of law, in most jurisdictions, you would actually be required to initiate investigations when you have PII plus a clear case of non-compliance. In this case, tax evasion, tax fraud, which would be a criminal case. So we will have a lot of information coming in. We will have a lot of investigations that are triggered. And what I see is that really in more than 90% of these cases of investigations will be triggered through global information reporting. So it has not only effects on the service providers that need to file this information and send it to the government for evaluation purpose, but also for law enforcement bodies and police on how they investigate. Because if we look at investigations, how they are proceeded so far, we really see that often they're just looking at a very small portion of the bigger picture. In 90% of the cases, criminal investigations that have to do with digital assets really just focus on the on-chain part. It's really about clustering of addresses, figuring out like what if something shady occurred on chain, so to say. The problem is, so if we look, for example, in practice, law enforcement would investigate a certain case, identifies shady behavior, and then they identify that a transaction was conducted to an exchange. So what they would do is they send a subpoena or information request to this exchange and receive their transaction data, or to a bank, for example, right? They would receive transaction data about this individual, and then investigations would stop. Because the problem that most law enforcement bodies and police are actually facing at the moment is bridging the gap between on and off-chain data and really, truly accomplish a follow-the-money approach and walk it through. So basically, because the question is, how would you launder money? You launder money by cashing out and by realizing. And most of the times you would go for an exchange, for example, for like some kind of off-chain source. So this is really where also, we had discussed this on another panel today, is really where we see also the compliance and investigation work going to, bridging the gap between on and off chain. So another very interesting topic that we have been working on quite extensively in the past 2 years, and that we are now also having pilots with some of the leading CI investigation authorities globally. So on the global information reporting requirements, also what's very, very interesting to see is that, and a question that I get asked a lot, why do countries, for example, like Dubai, Caymans, Seychelles, why do they join this framework of automatic exchange across jurisdictions? Why would a jurisdiction join this international global regime on information reporting that ultimately should identify non-compliance in the tax space when they don't even have taxes on crypto? Right? Why would a country that not tax crypto join this framework? Anyone has an idea?
Comply with the USCD, because they don't want to be on the grey list or something like that.
Absolutely right. It's basically the same situation as with FATF regulation. So it doesn't matter. Like, since service providers that are based in CARF member state jurisdictions will be required to collect data about all of their customers, and we are not talking just about the domestic ones, but all of their customers. They will need to share this information with other jurisdictions. So they are not joining the crypto asset reporting framework because they want to now enforce taxation in their own country, but really it's just to be able to say, okay, we can share with jurisdiction XYZ data about their own taxpayers. Because what we are seeing, crypto assets are, like digital assets, are borderless by design. So a lot of people don't trade on domestic exchanges, so to say, but globally, somewhere else. So most tax administrations wouldn't know if a person would trade outside of their own borders. So this is really where the crypto asset reporting framework kicks in and really creates this uniform framework for global information reporting. My question to you, and also looking at time, is like, do you have any questions on that? Okay, timeline. So the crypto asset reporting framework is an OECD standard. So it's a recommendation. It's not applicable to the individual jurisdictions. So countries need to implement it into their own law. The European Union did so through DAC8, Directive on Administrative Cooperation, its 8th Amendment. Switzerland actually released a CARF implementation law. The US is joining it. So US didn't join CRS, right? Then they introduced FATCA. For CARF, actually the US will join as well. So what happens in Europe with the timelines is that from 1st of January 2026, every single service provider will be required to do, like for their new customers, to collect their tax identification numbers, every single one. And for pre-existing accounts, they have 12 months to collect their tax identification numbers. If they don't collect the tax identification number, they would be required to freeze the accounts from performing any further transactions within 60 days. So it's actually, and there's quite harsh penalties on these frameworks. We have it kicking in the UK as well. in 2026, so 1st of January 2026, we have it kicking in Dubai. In the US, there was 1099 DA introduced. So basically, service providers, namely in the US brokers, will be required to report on a transaction basis to the IRS also in 2026. So then there was a huge discussion also about the so-called DeFi regs, if decentralized finance would also be required to report. And the IRS/US Treasury actually introduced those regulations on the 28th of December, end of last year. It's very, very likely that this regulation will not hold up, the new administrations, and that Congress is going to kill it through the CRA procedure. But we will see, right? So the information collections, all service providers will need to have sufficient mechanisms in place for information reporting from 1st of January 2026, not just for the KYC part, but also track transactions in order to be able to actually report to the government, right? So this is going to be a very, very big challenge for many. As Taxbit, we are kind of like one of the very few, if not the only solution provider that does this on a very big scale. So very, very happy to discuss this further in person for anyone that is interested. And thank you so much for taking your time. I know it's a very, very intense topic, but it's a topic that everyone should be aware of because it's going to be kicking in very, very soon. And 2025 is the year to prepare for it because the problem is with back bookings, and we know this from CRS, it doesn't properly work. So if you don't have a system in place from 1st of January 2026, you will be struggling really hard to comply with those requirements. Yes, Sandra?
One for you. What are the chances now that the US actually pulls out?
So, yes, so that's a very, very good question. Basically, the US won't pull out from the information reporting requirements because there are already information reporting requirements in place. So you have 1099 DA, and that will go through at least for SECs, right, for centralized exchanges brokers. The question is, will the US pull out of the automatic exchange of information, right, where they share the data that is collected within the United States with other jurisdictions and governments as well? There is a chance that this will happen. The problem is, like, the question is, will they implement the relevant laws in order to be able to be allowed to do so, right? Because the reason why the US didn't join the automatic exchange of information under CRS was because by law they're not allowed to do so. So the US would actually need to formally introduce a law in order to implement the legal foundation to be allowed to participate in this global exchange of information. And then again, coming back to like, what's the incentive of a jurisdiction to actually do that? I'm not sure if the new administration is actually interested in doing so, but of course, it would be well, it would resonate well with other jurisdictions if it would be implemented. Like I said, because FATCA and CRS reporting is just a pain. So, but I can't give you a definitive answer on that. But I think that there will be some kind of information exchange, definitely. May it be on like on a global basis or bilateral, multilateral agreements between the US and other jurisdictions. But there will always be jurisdictions that say, to jurisdiction XYZ, I'm not going to send any data. And that's their fair right to do so.
So if you're a large crypto bag holder, you would just move before it was actually reported in your jurisdiction to, I don't know, Dubai or something.
Exactly, but then again, that the moving part would only be incentivized if your jurisdiction is actually taxing crypto, right? Because your jurisdiction could have the knowledge that you own crypto, but if you don't get taxed, they don't care.
No, retrospectively report it to where you were based before, no?
Yeah, exactly. Exactly. Yes?
So, assuming there's going to be a tension between the EU and the United States, right? And assuming that Trump does what he says, because if he doesn't change the law, he doesn't avoid it, and he's the felon again, and his own government's going to go after him, because what he did over the weekend is against every securities law and tax law in the United States. So it's very unlikely that he's not going to go in that direction. Do you think that the EU moves towards the US? Or do you think that the U.S. somehow moves towards the EU in terms of regulation and transparency and, the prohibition?
It's two questions, actually. So on the automatic exchange of information, both jurisdictions are interested in actually participating, because the US is interested to get information from the European Union member states about their own taxpayers if someone trades within Europe, and the same vice versa, right? The EU countries want to know if someone trades in the United States. So for the automatic exchange of information, I feel like it's actually a win-win situation, because they will get, like, ultimately, what does the jurisdiction want? They want to participate in the revenues, right? But when it comes down to regulation, what I see happening is that in the United States, probably there will be a more relaxed approach or less harsh approach on decentralized on DeFi. So what we see on the OECD level at the moment is the question, is DeFi in, yes or no? And the answer from the OECD is yes. By default, the decentralized finance is in, and DEXs would need to report. So Uniswap would be, for example, required to report, which is obviously not the case, because but the burden of proof lies on the entity that they tell the government, oh, we are actually not required under these regulations to report. So how do we assess this? The OECD wants to introduce the so-called COSI assessment that was developed under FATF regulation. So basically see if an entity holds control or sufficient influence over a trading venue that is effectuating transactions. I see that the US takes a less strict approach on that. I see other jurisdictions taking a more focused approach, so to say, because ultimately, like I said, they all want to receive information.
I think there's a good chance the US stops taxing crypto transactions.
And like I said, exactly. But then again, the US wants to be an innovative country. They want to get people in, and tax is always a roadblock. However, the US is very, very interested in gathering data. They are very interested in having data. And that's why I see a big incentive on their side as well.
I wish we could have Max for an hour more, 2 hours more, to answer all the pressing questions on tax. We have a very captive audience on tax. It's not very common. Thank you, Max. Round of applause.